So what are the characteristics of a successful investment company? Why do some investment trusts languish on discounts while others trade on premiums and issue shares? These questions were at the heart of a recent high-profile conference on the future of investment trusts held last month, and were written up by Merrill Somerset Webb and various others in the financial press afterwards. There were questions I thought about a great deal for several years when I was manager of the Halifax Fund of Investment Trusts from 2009 to 2016. And they were also the focus behind the investment proposition that eventually became Aberdeen Diversified and Income and Growth Trust at the beginning of last year. So I'm keen to share some of those thoughts with you this evening. But for those of you who don't know it, Aberdeen Diversified Income and Growth formed a year ago, just over a year ago, at the beginning of 2017, from the merger of Aberdeen UK Tracker and the Old British Assets Trust. And Mike Brooks and I were appointed to run a multi-asset portfolio targeting LIBOR plus 5.5% per annum net of fees over rolling 5-year periods. So how you define success really depends on who you are. Tonight, of course, the England football team have just kicked off in Moscow, and they've got a very simple definition of success. They want to lift the trophy and emulate Bobby Moore, who was on a stamp 30 years later. And they want to be talked about forevermore on TV programs about the World Cup, and talked about in a good way, that is. Around the time that Bobby Moore was lifting the Jules Rimet trophy, NASA had a very simple definition of success. They had to meet President Kennedy's challenge to land a man on the moon and to bring him safely home to Earth. How about this chap? How would he define success? What is a success for your investment company? This is a question I quite often ask chairmen or directors of boards of investment trusts when I was managing the fund of investment trusts. And I got a range of really quite interesting answers. In some cases, I saw one look of almost blind panic on their faces because they'd never actually thought about it in those simple terms. And you could see them thinking about their board packs and their annual reports with their KPIs and all these other things. But actually, how did they define success? Mostly, they came around to an answer something like this, which was a direct quote from one of those meetings. And they focused on beating their benchmark and outperforming their peer group. And I'm sure many shareholders would be quite happy about that if they're investing in that particular asset class. But to my mind, that was the definition of success for the investment manager rather than the investment company. Few investment managers get sacked for outperforming their benchmark, but it wouldn't necessarily mean that the company was a success. And so existing shareholders might agree with that sentiment, but what about new shareholders? Because when you think about it, the shareholders of an investment company are also the customers of a long-term savings vehicle. And that's quite unique in the world of investment. By being a shareholder in Tesco, you're not a customer of Tesco. For an investment company, you are. The failure to attract new companies can be fatal, as Toys R Us eventually found to its cost. And the story is instrumental, really. Because every year, a group of Toys R Us customers would leave the store perfectly happy with the products that they'd bought, but they would never, ever go back. And that was because, in many cases, their children had grown up and were no longer attracted by the offer that Toys R Us had. And investment companies, so Toys R Us was not only battling against Amazon and Argos, but it was also battling against Father Time. It had to keep recruiting new customers. In some ways, investment companies are exactly the same. As people get older, they retire and draw down their savings, and so they're often selling down some of their savings, and ultimately there is an ultimate lifestyle investment decision that they don't have any control over. It's difficult to tell how investment companies fare against that battle against Father Time, but there's one company which has given us some interesting data which shows us how things might look if you're struggling in that battle. This is a trust that gives you every year the number of individual shareholders in its share register. And in 2003, when they first started publishing the data, they had 35,000 shareholders and they owned around 50% of the company. But since then, the number of shareholders has fallen pretty steadily by around 1,000 a year. So in the last set of report and accounts, they had fewer than 18,000 shareholders who owned around 80% of the company. And against that backdrop, share buybacks had to take up quite a proportion of the slack. Fortunately, not all investment companies are shrinking in that way. And this chart shows the 180 or so companies in the FTSE All-Share Index. Around a third, just over a third, are growing. They're issuing new shares. They're attracting new customers every year. This is the figures for the last 12 months. But around a third are stable, and a little under a third are shrinking. They're buying back shares, and they're facing pressure because they're not replacing some of those customers. So what are the areas where companies are growing? Which are the ones that are successfully attracting new customers? Well, this is a chart which shows the world of listed alternative funds, infrastructure funds, specialist funds, debt funds, property funds, private equity in yellow, and hedge funds in black at the top. But certainly there's been a tremendous growth in the last few years in infrastructure and other alternative asset funds. And they offer great things in terms of offering access to new and diversifying asset classes for those of us who are multi-asset investors. The closed-end fund structure really is ideal for holding those long-term assets. If you're a manager of an open-ended property fund a couple of years ago at the time of Brexit, and all your customers wanted their money back, you couldn't sell the buildings fast enough, and the open-ended property funds closed for a period of weeks or months for things to rebalance. If you've got long-term assets such as schools or hospitals in an infrastructure fund, the closed-end fund structure is ideal for that. And as Tom mentioned, investment companies can use dividend smoothing and revenue reserves to ensure they have flexibility in their delivery of their income. And some investment companies now are even going further and paying out capital as income. It's not something we do or need to do, but some companies are doing that now. International Biotech is one recently, and a number of others that are taking on that mantra. The other characteristics of growing investment companies, I think the ones that I identified were those with a differentiated investment proposition. Think something like Scottish Mortgage. I used to run the UK equity portfolio of Scottish Mortgage up to 2000. It's a very different portfolio now, and James Anderson has built a massive following by focusing on very differentiated investments that you can't really invest in elsewhere. Another area I identified as a manager of a fund of investment trust was that often the managers I met, they were keen to promote their open-ended fund. And in the world of wealth management, wealth managers are quite keen, in fact very keen, to invest in open-ended funds because it's simpler for them when they're investing for a lot of clients. And at the conference I mentioned earlier, Mark Dampier was particularly keen on the open-ended funds because that suits their platform and it suits the way that they can suit their customers' needs. Investment companies are more complicated, and so to encourage people to invest in them, they need to be differentiated from the open-ended fund managed by the same manager. So those are the three characteristics I want to focus on: long-term investment, income, and differentiation. And those were the thoughts that went behind what we were doing when we set up the prospect that became Aberdeen Diversified Income and Growth Trust. In terms of differentiation, our key, our USP, as it were, is being able to invest in really the widest range of asset classes across the whole investment market. And we're able to do that with the help and understanding and insight of all the teams at Aberdeen Asset Management at the time, at Aberdeen Standard Investments now. We can capture the breadth of opportunities in funds and assets managed by our colleagues at Aberdeen Standard. And it's across the full range of asset classes. So starting here, we have equities on the left in the dark colour, equity-focused asset classes, developed equity or emerging markets or or private equity. And on the right, we have lower yielding, more defensive assets, which are such as government bonds or investment grade credit, not an area we're focused on at the moment because of the low yields on offer. Our area of focus is in the middle, in these diversifying asset classes, where if you're looking to broaden your income horizons, these are areas that are researched or managed by teams within Aberdeen and that we can take advantage of. In terms of, in the purple, alternative forms of credit, such as asset-backed securities or emerging market debt. In the middle, more real assets, such as property or infrastructure, or to some commodities, and again, not an asset class we currently invest in, but we could. And on the right-hand side, more market-neutral assets that aren't driven by the vagaries of investment markets. So those are that's our canvas. And our open-ended fund can invest in exactly the same set of opportunities to the large part in terms of asset classes, but our closed-ended fund, Aberdeen Diversified Income and Growth Trust, can invest in specific long-term funds and capabilities that are not available to our open-ended fund. And as a result, you get a 1% premium in terms of our target return for our Aberdeen Diversified Income and Growth Trust compared to our open-ended funds. So as an example of the kind of long-term investment that we've made, this is a fund, Aberdeen Global Infrastructure Partners 2, that launched in 2014. It's managed by the concession infrastructure team at Aberdeen. Standard investments came from the Aberdeen Heritage that built this, were part of the consortium that built this stadium, the Optus Stadium in Perth in Western Australia. So this is a project that started in 2014 and completed at the end of last year, built in 3 years, on time and on budget. And by having the capabilities and knowing who you can work with to go from a greenfield to a new stadium there in a pretty short space of time, which is now open and saying we'll host the next Ashes series. That's the WACA, the Australian cricket ground, is that one over there, and straight across the Swan River from there. This stadium is now leased to the Western Australia government for 25 years. And the premium, the risk premium that fund took on to develop that asset is now reflected in a higher price now that it's up and running. And that fund will target double-digit returns net of fees by going from a greenfield to that kind of investment. And this fund has investments in schools, in law courts in Australia, in road and transport systems, all on this development basis. And it's an investment you can't invest in directly because it's an institutional fund, but we've bought a stake in Aberdeen Diversified Income and Growth Trust, so you can invest in that development infrastructure capability through our fund. And most infrastructure funds you might be familiar with, Hickle or John Lang Infrastructure, they buy completed assets at higher prices because they don't have that capability to develop assets like this to any large extent. Another example of a type of asset that we can invest in is farmland. People sometimes say, I really like to invest in farmland, but how do you do it? Well, we know a team that knows how. Our real assets team, based in Boston, in Massachusetts, rather than Boston in Lincolnshire, they found for us an agricultural fund managed out of the west coast of the United States, investing in blueberries, in citrus, in pistachios, in nuts, in grapes. This specialist manager is taking existing farms, converting them into organic production, and that capability, when it's worked through, allows we will develop double-digit income yields when those farms have gone through that development process. So this is a long-term investment. This fund has an investment period until 2021. An initial investment period in terms of buying assets, and then 5 years or so to develop those assets, and another 5 years to sell them on. So this is the ultimate in long-term investing, and it's a very different investment, and it's a high-yielding investment, but it's a very different investment to many of the other things that you can invest in. The risks here are crop disease, they're crop prices, they're pestilence, whatever. But they're different risks, importantly, from the other risks we face in our portfolio. And that's why we invest in a fund like this, to diversify our pool of risks. And it really is the way to take advantage of the diversification characteristics of an investment fund. So this is our entire portfolio. We have we have 12 asset classes. You'll be pleased to know I won't go through them all, but we listed equities on the top left. We've got a fifth of the portfolio invested there. Infrastructure, and in the bottom, we have about 12% in infrastructure. I'll talk a little bit about emerging market debt in a second, around just under a fifth of the portfolio invested there. The two columns of weighting show the current weighting in the portfolio at the end of March, and the column on the right shows our longer-term investments that we've made, where we've made a commitment to a fund such as the Agricultural Capital Management Fund, where we've made a commitment to 1% of assets, and we've currently invested about half of that, because that fund manager has found opportunities at around to invest half the money so far, and we'll invest the other half later as those opportunities come through. In terms of the income that generates from our portfolio, this is the chart showing the income from that range of asset classes. A reasonable chunk of around just 30% coming from emerging market debt, only around little over 10%, 10 or 11% coming from listed equities, similar amount coming from infrastructure, and around a fifth coming from asset-backed securities. But we've also got a wide range of things. In our special opportunities area, we have lease income from leasing aircraft to the Emirates airline, for example. We've got healthcare royalty fund. We've got insurance-linked securities, which underwrite insurance risks on catastrophe insurance. So a wide range of different areas that are generating income, a very broad spectrum in terms of that income. In terms of comparing that to the FTSE, I mean, Tom mentioned that earlier, this is actually the income from the FTSE 100 in terms of the top 10 holdings shown here. So little over, if you have a FTSE 100 tracker with its 4% yield, more than half of your income comes from 10 shares. Nearly a quarter comes from energy companies. Royal Dutch Shell has more income for a FTSE tracker than we get from our entire listed equity portfolio. And so that means that if you're sceptical about the oil, as James Anderson, who manages Scottish Mortgage, very clearly is, you have to be worried about the sustainability of your income from that area. This is our equity portfolio. We've got our biggest equity holding is a Japanese trading company called Itochu, only 0.3% of our entire portfolio. And this is a portfolio focused on value and quality investments that are selected for us by our quantitative investment team in Edinburgh. It's a fund of around 200 equity holdings, with in total around 8% invested in the US, 3% in investment in information technology. Emerging market bonds is an area that's in the news at the moment, and we think that's a very attractive yield of between 7 and 8%. We've got, again, a well-diversified portfolio by different countries. One or two of them have been in the highlights. Turkey, we've got 1%, just under 1% of our assets in Turkey. That is facing some challenges, but a number of the other countries have, some are commodity producers, others are commodity users, and there's a well-diversified portfolio of emerging market bonds and a very wide spread. This is the chart of emerging market bond index against developed market bonds. Very wide spread and a premium you're earning for investing in emerging market debt. Not without risk, but different set of risks. So earlier in the year, when global equities fell by 10% in January and February, global emerging market debt currency bonds were actually up in sterling terms at that period. So to summarise Aberdeen Diversified Income and Growth Trust, we're taking the full advantage of those capabilities of the closed-end fund structure to invest in a wide range of attractive, longer-term income-generating assets. And we think this is the best way you can broaden your income horizons. And in many cases, we're not investing in the things like I showed in terms of Shell and BP and all those companies that you can invest in through more conventional means. Has an attractive yield of 4.3%, competitive fees. And Mike Brooks and I, my co-manager, when we were keen to, as closed-end fund investors ourselves, we were keen to ensure we have a robust discount control policy, and our shares are trading pretty close to NAV at the moment. So to me, that defines, that focuses on some of the areas of success in the world of investment companies. And in terms of defining success for us, it's more than beating our target of LIBOR plus 5.5% per annum. net of fees over rolling 5-year periods with less than half the volatility of global equities. It's more than that. We want to get more customers into our proposition and give them the opportunity to invest in these kind of investments that we've identified. So in terms of defining success for one day and hopefully 2 more weeks, when I put this slide pack together, I had to do it in advance. I had to come up with a prediction of who would be in the World Cup final. I came up with England 2, Germany 2 as the score. And after extra time, with England winning 3-0 on penalties. That was my definition of success. Little did I think that Germany would let me down and that England, at least as we speak, 5 minutes into the game, are still there. So thank you very much for your attention, and I'll hand over to my colleague, Jason.